Ladies and gentlemen, good evening. My name is Ilias Pertunias. I'm the Executive Director of the American Hellenic Chamber of Commerce. And on behalf of the Chamber and our friend here, Stephen Flood, we welcome you today to this seminar on tax issues in U.S. First of all, I would like to thank Stephen Flood. This is the third time in a row that we organize this seminar, and I see every time we organize it, I see more people attending the workshop, and I guess there is much, let's say, there is a need of information regarding, the taxation rules, and as a chamber, we are committed in providing any kind of information along with our colleagues and friends here. I would like to thank also Raymond Matera and his colleague Greg Fry. Raymond is the business editor of the editor of the Business Partners magazine that you have in your hands right now. My colleague Katerina Zagaroulaki, who coordinated the whole seminar here, and the rest of the personnel of the chamber. Allow us to add you, since we have your names and your emails, to add you on our contact list, and so we'll keep sending you some information, not only for taxes, but for any other event our chamber organizes. And also, I forgot to mention to thank also the U.S. Embassy for circulating the announcement of this seminar to all of you. Also, I apologize to some of you who came earlier here today. By mistake, some of you were misinformed about the timing of the conference, of the workshop. And I apologize for this. So let's continue. Thank you for being with us. And Stephen, I would like to thank you for one more time, supporting this initiative. So you have the floor right now, please.
I'm going to carry out a demonstration now of turning off a cell phone. This is how you turn off a cell phone. So do you want to turn off your cell phones? And that was my Greek cell phone. Now I'm going to take my U.S. cell phone and I'm going to turn it off as well, though highly unlikely anybody will be up early enough to call me from there. Anyway, good afternoon. Welcome to an entertaining couple of hours on U.S. tax. I'm sure you're excited about this. You've been waiting for this kind of an event for probably years, really. And so those of you who came really early as a result of the embassy's sort of foul up on the time, I'm sorry about that, but I hope to make this next couple of hours at least informative, and to the extent that anybody can make tax at least interesting, if not entertaining, I'll do my best. So the first slide is the most important slide in the presentation. And I say that because I'm not here to defend the laws and regulations you're about to hear about. That's not my job. Those laws were enacted by the United States Congress. The regulations that have been adopted by the U.S. Treasury and the Internal Revenue Service of the United States. I don't run any one of those agencies or entities, and I'm not in charge of Congress. So my job as a lawyer, as a tax lawyer particularly, is to make sure you're well informed about what the law requires. It's not my job to tell you that it's a good law or a bad law. In fact, I'm going to comment during the afternoon that I think some of it is just plain stupid. But that doesn't matter. It doesn't matter what I think. It really doesn't matter what you think. What matters is what you're obligated to do by law with respect to your U.S. tax and financial account reporting. So, let's begin now. Some ground rules. Number one, the first half of the program deals with tax returns. The second half of the program deals with foreign bank account reports, the famous FBARs, and FATCA, the Foreign Account Tax Compliance Act. So don't try to ask FBAR and FATCA questions during the tax section. All right? That's unfair. So we're going to keep to the rules. All right. There are cameras here. This is being video. The embassy wanted to have a video of the session available, and it'll be posted on the Chamber's website. But when the question and answer period comes, the cameras are not going to zoom in on you. All right? So you can feel free. They may zoom in on me, all right? But they're not going to zoom in on you. And during the Q&A period at the end of each session, there'll be 3 microphones. We've done this enough now that we've actually got a good idea how to do it in a reasonably organized way. There'll be a microphone in front of this area, a microphone in front of the area over there, and a microphone upstairs. And then if you want to ask a question, you can go behind the mic, ask your question, and then we'll just go from 1, 2, and 3. The last thing I'll ask you to do is, if you've come away from this session with some useful information, the slide pack will be available also on the Chamber website. So share the information with those of your friends and relatives who couldn't be here or out of Athens, so that at least the information gets out. The whole point here is we can lead a horse to water, but we can't make him drink. My job is to lead the horses to water. Okay? All right. What are we going to cover today? Well, we're going to cover taxation. That's the first half. Who has to file? Something called a foreign earned income exclusion. The foreign housing exclusion or deduction, not terribly important probably, but we're going to cover it for completeness. Foreign tax credits, Social Security, and what to do about unfiled U.S. tax returns. In the second half of the program, we're going to talk about the foreign bank account reports, who has to file them, what is this new streamlined foreign offshore procedures that were adopted last June for unfiled FBARs and tax returns. We're going to talk a little bit about the Offshore Voluntary Disclosure Program. We're going to talk about the Foreign Account Tax Compliance Act, known as FATCA for short, and that will involve the Form 8938. Who has to file? What are the penalties? And the other part of FATCA, which involves the foreign banks, Alpha Bank, Ethniki, etc., joining the 145,000 other foreign financial institutions around the world in reporting U.S. financial accounts to the U.S. Internal Revenue Service. All right, what's the starting point? The United States is the only country in the world that taxes its citizens based on their citizenship, in addition to substantial presence or residence in the United States. So if you're a U.S. citizen, you're subject to tax on your worldwide income wherever you live. Being subject to tax is not the same as having to pay tax. And that's going to be an important distinction we're going to go through today. Tax is levied under the Internal Revenue Code even if no income is from sources within the United States. So the fact that Greece may tax a certain kind of income one way, irrelevant. How the U.S. will characterize and tax that income is all that's relevant in your case. All right, who is a U.S. citizen? Well, according to the 14th Amendment to the United States Constitution passed in the 1860s, anyone born within the United States is a U.S. citizen by birth. And that is as simple as it gets. If your mother was there on vacation and you were born there, you are a U.S. citizen. If, like many millions of undocumented aliens in the United States, your parents snuck across the Mexican border and gave birth to you, you are a U.S. citizen. So, in simple form, if you were born in the United States, you are automatically a U.S. citizen. You don't have to have a U.S. passport. You don't have to have a U.S. Social Security number. You don't have to have done anything ever in your entire life to have exercised a single U.S. citizen right. You are a citizen. And of course, in your Greek passport, it's going to say born in Texas or someplace else in the United States. And so you're instantly identifiable to your banks as a U.S. citizen. Anyone born to U.S. citizens outside the United States is a citizen of the United States by birth. Anyone born to a U.S. citizen parent, the other parent might be a non-U.S. citizen, who registers that child's birth at a U.S. consulate abroad is a U.S. citizen at birth. And the obvious person is anyone obviously naturalized in the United States. Now, who files? Well, we start with filing status. And this is going to be very important. Single, whether you're under or over 65. Next, head of household. Basically, this is a person who is unmarried with a dependent child or deemed to be unmarried by the code. Married, filing jointly, under or over 65, both spouses or only one spouse. Married, filing separately at any age. A qualifying widow or widower, under or over 65, with a dependent child. A qualifying widow or widower is a taxpayer who is eligible to file a joint return for the year in which their spouse dies. The spouse died either during either of the 2 years immediately preceding the tax return. The taxpayer is not remarried, and the taxpayer is at least one dependent who resides with him or her. I didn't have that definition in there last time, and some people asked me, and I said, well, I'll look it up and tell you. All right. This chart is important because it determines what your gross income has to be in order to have to file. Now, it's important for you to realize every single U.S. tax return must be filed in U.S. dollars. If you earn money in pounds, if you earn money in euro, if you earn money in any other currency around the world, it has to be converted to U.S. dollars in accordance with the Internal Revenue Service regulations, which prescribe a specific exchange rate for each currency around the world, and you can find that exchange rate on the IRS website. So, whenever I use these numbers, think of it in terms of the equivalent of. So, if you're single under 65, your gross income must be $10,150. Essentially, you can just look down the list and you can pick yourself out. What stands out, of course, is married filing separately, because that's a very low filing threshold, $3,950. Now, what's gross income? Well, you exclude Social Security benefits in calculating gross income unless, this is a typical tax law. You do something unless and then you give an either or. So it makes it all the more difficult to understand. But you exclude Social Security benefits unless you're married, filing a separate return, and you live with your spouse at any time during 2014, 11, 12, whatever year it was. Or 1/2 of your Social Security benefits plus your other gross income and tax-exempt interest exceeds $25,000. So if you have more than $25,000 in gross income, having excluded half of your Social Security benefits, then you have to report all of your Social Security benefits. Now, right, I'll get to Social Security. I'll get to the Social Security reporting deadline, reporting requirements a little later and how they're taxed. But just in calculating your gross income, in this example, if you're married filing separately and you live with your spouse, this will be a case where you are a U.S. person married to a non-U.S. spouse. You may very well, our default position is for U.S. citizens with non-U.S. spouses not to file a joint return. The reason is that you then voluntarily subject your spouse's income and assets to U.S. taxation on their worldwide income. And often that will not be a good decision. So in this case, you would fit into the first category, in which case you could not exclude your Social Security benefits and you'd have to file a return. All right. Let's get into taxation. And first thing is the most misunderstood, one of the most misunderstood aspects of U.S. taxation. It's called the foreign earned income exclusion. This is one of the benefits that you get as a U.S. citizen living outside the United States. The foreign earned income exclusion allows U.S. citizens who are bona fide residents in a foreign country or who have a physical presence outside the United States to exclude up to a set amount of earned income from U.S. tax. Now, a bona fide resident is essentially a facts and circumstances case. We're representing a South Korean U.S. national in a tax court case in Washington in which the Internal Revenue Service refused to give this pilot who worked for South Korean Airlines in Seoul, South Korea, or at least from Seoul, South Korea, they refused to give him the foreign earned income exclusion, and the issue in the case is whether he was a bona fide resident of South Korea during the tax years in question. So it's a facts and circumstances test. Generally, anyone who lives outside the United States, has set up a home here, sends their children to local schools, etc., is going to meet the test. And certainly, if you're required to pay tax where you live, you're going to meet the test. The physical presence test requires that U.S. citizens live outside the United States for no less than 330 of any 12 consecutive 12-month periods. It's important. This is an absolute up or down test. 329 isn't good enough, which means that if you go back to the U.S., you came from the U.S., let's say, in the 1st of July, 2013, and you stayed in Greece until the end of February 2014, and you went back to the U.S. for 35 days in March and early April, and then returned to Greece, you can't start your consecutive 12-month period because you've already gone over the 30 days. So you're going to be very close to the 330. It's an absolute up or down test. 329 isn't good enough. 330 is essential. The days don't have to be in one tax year, as I've just demonstrated, but counting can be tricky, so you have to be careful. U.S. citizens working for the U.S. government in a foreign country or for an agency of the U.S. government cannot use the foreign earned income exclusion. All right, what is the exclusion? For 2011, it was $92,900, and for 2014, it was $99,200. Remember, the value of the exclusion is always calculated in USD. Now, this is where things get tricky with people who don't understand the concept of FEIE. It is earned income. That means wages, salary, commissions, bonuses, tips, fees, things that's paid for work. Consider it as active income. Interest, dividends, capital gains, rents, etc., are not earned income. I don't know how many people I've heard tell me, well, I earned less than $97,000 and so I don't have to pay any tax. Well, no. What if $97,000 was in rent? Right? It's not excluded. So there's a big misconception about the foreign earned income exclusion. Keep the word earned high in your mind. Okay. U.S. Social Security is not earned income. Neither is Greek Social Security income. Neither is pension income. If you're being paid a pension by an agency, an employer in the United States, if you're being paid a pension by an employer in Greece, it is not earned income, and it is subject to tax. So FEIE cannot be used to exclude U.S. or Greek Social Security payments, pension payments, annuities, etc. Now, both spouses in a working family can take FEIE. if they both work and meet the residence and physical presence tests. They don't have to meet the same test, but each of them has to be able to use FEIE independently. FEIE also automatically triggers the alternative minimum tax. When Congress enacted the AMT law in the 1960s, the objective was to make sure that U.S. citizens who were wealthy enough to earn income from passive investments that were tax favored, like municipal bonds or lower interest tax bonds of certain descriptions, or took advantage of other what were called tax benefits, they had to pay some tax. And so the alternative minimum tax system was developed to ensure that they ended up paying some tax. AMT is forbiddingly complex, and the fact of the matter is it's impossible to explain. I think it's impossible to explain. Generally speaking, the AMT is calculated as if your foreign earned income was not taken. So everybody who claims FEIE has to file an AMT form with their IRS return. The FEIE can only be claimed. It's not automatic, okay? You've got to claim it. How do you claim it? Well, you file a Form 2555 or a 2555EZ with your Form 1040. Now, the tricky part is that earnings above the FEIE limit, so let's just posit a U.S. citizen resident in Greece earning 120,000 euros a year. When you convert that to USD, we now have roughly 138,000. Only 99 for 2014, 200 is excluded. So we have some income above the excluded amount. The tax you don't start getting taxed at $0. You start getting taxed at $99,201. So you go to the schedule of taxes and you start calculating your tax at the $99,201 level, roughly about 28%. Now, I'm going to go through this fairly quickly. This is called the foreign housing exclusion. Essentially, this is really for those U.S. citizens who are temporarily overseas and who are being paid by their employer some form of housing allowance to account for the differential between what would be normal living expenses at home and a more expensive destination where they work. It's generally a matter of negotiation between the employer and the employee and will depend largely on whether they're stationed in Bangkok, Bangalore, or in Rome or in Paris. For those of you who are permanent residents of Greece who live here, this is really not terribly relevant. So as I said, I'm going to go through it fairly quickly. It starts basically with your foreign earned income exclusion. 16% of that is considered your base housing expense. And anything above that then can be excluded. The assumption is that if you lived in the U.S., you'd be spending $15,000 to live anyway, so we're not going to give you an exclusion for that. I don't get to deduct my living costs from my tax return. And ultimately, anything over that, the differential can be deducted or excluded. You can look here at Athens. It's a separate situation. It's got a $42,000 maximum, so if you would separate the difference, you would subtract effectively, in your case, the difference, and that's what you would be able to exclude. Remember, that's payments being made to you by your employer that you're excluding from tax. Right? And the deduction effectively is the same, except for self-employed people. So you've got the exclusion for employed people and the deduction for unemployed people, for self-employed people. My wife always said when I claimed to be self-employed, she said, "You're gainfully unemployed," which is, I guess, another way of putting it. All right. What's the alternative to the FEIE? Well, for those of you who live in a high-tax jurisdiction, you're going to want to investigate using the foreign tax credit Now, what is a foreign tax credit? Well, taxpayers can apply income taxes paid to a foreign government on income as credits to their U.S. tax obligations. So, the fellow who is earning the 120,000 euros as salary will have paid taxes to the Greek state at a level higher than he would have paid if he had been living in the U.S. and earning 135,000 USD. Because the maximum tax rate of 39.6% for 2014 doesn't kick in until the adjusted gross income exceeds $250,000 in the United States. So it's very likely, knowing the tax rates that apply in Greece and the levels at which those rates apply, that virtually everybody who's an employee will have far higher credits than they will have U.S. tax exposure on their earned income. So what they can do is use those Greek taxes paid as a credit against U.S. taxes on the same income. VAT, business or real estate taxes, eforia or anything else, or other taxes not levied on income are not available for foreign tax credits. So it's only credits on income taxes. Now, obviously, the solidarity tax is a tax on income. Now, it's applied on all kinds of income, but the fact is, it is itself an income tax. Now, credits aren't in one large basket. Foreign tax credits are divided up. You can ignore the 901J or the income resourced by treaty and lump sum distributions. I put that out there just in case there's some smart, clever tax lawyer out there who says, well, no, you forgot to mention 901J and lump sum distributions. So that's just to protect myself to know that I'm actually thorough here. What really applies to people in this room are the passive and general limitation. General limitation applies to salary, basically earned income. Passive refers to rent, interest, dividends, capital gains, annuities, pensions. So we have to look at the Greek taxation of your income, and we have to see which are going to be general limitation credits, which are going to be passive credits, because we can't swap them. We can't take income taxes paid on your wages and apply them to income taxes due on rental income, for example. We can use taxes paid on rental income, interest, dividends, capital gains against U.S. taxes due on the same kind of income, but we can't take our passive tax credits, if we have too many of them, and use them for our general limitation credits if we don't have enough, and vice versa. Most people sitting in the chairs in front of me are going to have excess general limitation credits if they use foreign tax credits, and they can't use them other than against other general limitation items. The Form AMT, the 116, there's a foreign tax credit form called a 1116. That has to be filed twice when you take a foreign tax credit. You have to take the basic credit, then you have to run it through the AMT formula, and AMT may end up reducing your foreign tax credits. Now, this is where things get a little tricky, because using the foreign earned income exclusion, in fact, deprives you of taking other tax benefits. Using foreign tax credits does not. So you need to understand what the implications are to your whole tax filing as to whether you want to take FEIE or you want to use your foreign tax credits. Generally, for somebody living in Greece, where you're in a high tax jurisdiction, you're going to want to use foreign tax credits as opposed to FEIE. The simple answer is, okay, I'm earning 40,000 euros, I have $200 in interest, that's my income, therefore I should use FEIE because I pay no U.S. tax. Not necessarily. Because if you take foreign tax credits on your 40,000 euros of income, they'll be much higher than U.S. taxes on the same income, and you'll be at the same place. But you'll have lost many other options and tax benefits, perhaps, depending on your situation, by doing that. The phase-out of certain tax benefits needs to be considered. The U.S. system has a phase-out for certain tax benefits. For example, at my and my wife's joint income levels, we can't take the charitable interest deduction. Sorry, not the charitable interest deduction. We can do that one. We can't take the medical deduction because it phases out as your income goes up. So there are certain benefits to child tax credit we can't take because our income phases it out. So the U.S. uses a phase-out for some of these tax benefits which have to be taken into account. Now, if you all lived in Saudi Arabia or somewhere in the Middle East, you're probably going to use foreign earned income exclusion because you paid no tax on whatever your underlying salary is. So whatever you're going to do, you're going to be better off using FEIE. That's not the case in Greece and most European countries. Now, Social Security. There are a lot of people in Greece who are retired. They worked in the States. They have some form of U.S. Social Security, either them and their spouses together. Well, I said to you earlier that there's a certain calculation for defining your gross income for purposes of having to file a tax return. Then there's a question of how much of your Social Security is subject to tax. So two different questions. One, do I have to file a return at all? And if I'm a recipient of Social Security, on the earlier slide, we were explaining how you'd go through that calculation. Now, if filing as an individual, your combined income, I'll explain that in a minute, is less than $25,000, your Social Security benefits are not taxable. If you're a married couple filing jointly and you earn less than $32,000, your Social Security benefits are not taxable. Up to half of your Social Security benefits are taxable if, filing as an individual, your combined income is between $25,000 and $34,000, or as a married couple, $32,000 to $44,000. If you're above those limits, 34 and 44, 85% is taxable if your combined income exceeds the limits. 85% of the Social Security benefits are taxable if a married person files a separate return. That's married filing separately. Now, what is combined income? Combined income equals adjusted gross income. Effectively, that's your gross income. There are several adjustments, most of which don't apply to most of us, plus tax-exempt interest and half of your Social Security benefits. So you go back to the previous slide, you add half of your Social Security benefits, let's say $10,000. You have 10,000 euros in a Greek pension, so you now have roughly 13,000 USD in your Greek pension. You have 10,000, of which you only include 5. Remember, you're only keeping half of your Social Security benefit. And then you have very little tax-exempt interest. Well, in that case, your combined income is less than the 25 or the 34,000. All right? So that's the calculation. Now, one of the other aspects of Social Security, something that the United States and Greece entered into many years ago called a totalization agreement. And while it's an awful word, it actually says exactly what they do. They've totalized the whole system. So that what effectively they try to do is prevent people from having to contribute to two systems. They want to coordinate benefits between the systems, and they want to make sure people don't fall between the chairs, that they get covered by one or other of the systems. Now, the point is you can't choose where your Social Security benefits or taxes are paid. That is determined by the agreement. So there's no choice here. There's a set of rules which we're going to go through in a minute. If you're working in Greece for a U.S. employer, then if you were sent to Greece and you worked in Greece 5 years or less, your Social Security payments, your tax payments, are made to the United States. If you're sent to Greece and you work in Greece more than 5 years, your Social Security payments are made to Greece. If you're hired in Greece by a U.S. company, your Social Security payments are made to Greece. If you're working in Greece for a non-U.S. employer, French employer, international organization, you name it, they're paid to Greece. If you're working in Greece for the U.S. government, and you're a U.S. national, and of course all of you are U.S. nationals who are here that are U.S. nationals, paid to the U.S., a Greek national paid to Greece. Well, what happens to you guys? You're both. You're dual nationals. Well, the fact is you'll be treated as a Greek national if you live and work in Greece as opposed to a U.S. national. The obvious corollary is that if you were in the U.S., it would be the reverse. So I'll give you a couple minutes to look at this slide, and it's a mirror image of what we just went through in terms of people working in Greece. Now, having to file a tax return is not the same as having to pay tax. So we start with the premise that your income has to be reported according to the U.S. tax code, but you're also allowed either to use FEIE or foreign tax credits, which may very well reduce your U.S. tax to zero. So filing a return does not equal owing tax. Next, the U.S. tax treaty with Greece, or the U.S.-Greek tax treaty, has a carve-out provision, as does every U.S. tax treaty around the world. It does not apply to U.S. citizens. So you can ignore the U.S.-Greek tax treaty. It simply doesn't apply to you. Period, full stop, the end. I think it's Article 11, C or D, and that's it. What does apply is that the treaty requires the United States to give a foreign tax credit to Greeks for Greek taxes paid on U.S. income, on the same type of income, and requires Greece to give a tax credit to U.S. taxes paid on U.S. source income when that same income is taxed in Greece. So the treaty provides for foreign tax credits, but you aren't exempt. And I can't tell you how many people say, well, gee, the U.S. tax treaty exempts you from tax in the United States. It doesn't. Why not? Because the U.S. taxes based on citizenship. And if the carve-out didn't exist in the treaties, that would undermine the U.S. citizenship concept of taxation, which, by the way, is not new. U.S. citizenship taxation has existed since the very first Temporary Income Tax Act was passed during the United States Civil War. And in fact, in that first statute, citizens who lived outside the United States were taxed at a rate twice that citizens living in the United States. That was actually designed to prevent people from running off to England to escape tax during the Civil War. When Congress, after the passage of the 16th Amendment in 1910 or 11, enacted the first Income Tax Act in 1913, that is 102 years ago, it simply carried forward the concept of citizenship taxation. So if anybody tries to tell you this is a new thing, it's not. And the second thing is that since the United States first began negotiating tax treaties with other countries, it has had in its code citizenship taxation, thus the carve-out provision that exists in all of the treaties. Okay. There is no statute of limitations on an unfiled tax return. What I'm going through here are the provisions of the code as they exist. So if you haven't filed a tax return for 2001, technically there is no statute of limitations. Excuse me? Meaning what? Means you're still liable to file the tax return. The statute of limitations, I'm sure you're familiar with the concept, says after a certain period of time, the legal obligation to do whatever it was you were required to do is gone. Under the U.S. tax code, that's not the case. Just relax now. Relax, folks. Relax. Okay. Relax. I'm just relaxing. All right. There's a 3-year statute of limitations on a filed return. So if you file a return for 2010, you filed it on time, 3 years from when that return was filed, so 2010 return filed in 2011, sometime during 2014, that tax return is now statute barred to the service. They can't do anything with it, absent fraud or some other things which probably aren't going to be relevant. In limited situations, the 3-year limit can be increased. What is one of the exceptions? The failure to report foreign source income. So here you are in Greece, you filed your U.S. tax return, but you said, well, gee, I was told that I only had to pay tax in the U.S. on the income I got in the U.S., and I paid tax in Greece on the income I got in Greece, so I don't report my Greek income on my U.S. tax return, and I don't report my U.S. income on my Greek tax return. Wrong and wrong. So here you are, you filed for 2011, but you happen to have $4,000 in rental income in Greece that you did not disclose on your U.S. tax return. You would be within one of the exceptions to open up the 6-year statute. Again, relax. Penalties are based only on tax due. So if you don't owe any tax, the maximum penalty you can pay is $135. And most of the time, the IRS is never going to assess that anyway. So if you don't owe any tax, you really have no penalty. So the tax return isn't really your big enemy in this situation. It's not the big fear. Because most of you are not going to owe much tax. And let's say you owe $1,000 in tax. Well, the penalties may be about $1,000. So the penalty in the U.S. tax environment is driven by the amount of tax due. If no tax is due, the penalty is a maximum of $135. Now we have question time. And what we're going to do is we're going to have somebody stationed over here, somebody stationed there, and somebody upstairs. And what I ask you to do is just, remember, the camera's not going to put you, we're not going to put you on camera. All right? So if you want to ask a question, just go behind one of the people with the mics, and then we'll start that way. I'm not sure where the mics are yet. They're coming in. So just step over there. That'll be, see, Katerina is there? Okay. If you have a question, just go on back to Katerina and speak into the mic. That way everybody can hear you and you don't get caught on camera. Yes, go ahead. Yes, sir. Bonuses, you mean? Yeah. Mm-hmm.
So it's, I don't know if it's called a bonus, but it's just a lump sum that is given to people at the time they retire. So is this an earned income or not?
That's earned income.
That's earned. Mm-hmm. Another question. The unemployment benefits.
Unemployment benefits are taxable.
They are taxable, so it's considered earned income?
You know, I don't know. I haven't represented anybody with unemployment income yet, I'm afraid. So yeah. I actually have never actually confronted that question. I would think it would be earned income because it's paid, but it could be considered an insurance payment.
Like an insurance payment.
Yeah, but I don't know. I'll be honest, I don't know.
Okay. That's all.
Okay, over here.
Some of us have naturalized our children. And the question is, at what age does their obligation, if they have an obligation, I understand they do, what age this obligation begins?
Well, the obligation is not age-specific. The obligation is income-specific. So if you have a 4-year-old child who grandma leaves a big bunch of money for, and that's put into an interest account, and the child essentially is earning $10,000 in income, right, then that child has a tax filing obligation.
4 years old.
At 4 years old.
Okay.
I mean, because remember, that is an individual, right, earning income. Mm-hmm. Now, most of the time, the parents will take that income into their own and declare it for them. But technically, a 4-year-old with a $250,000 fund that's in his name and is paid in his benefit, and you'll appreciate that there are many parents who are high net worth who will create this kind of income, all right, in order to essentially lower their own income, because the child is going to be paying tax at the 0 rate for the first several thousand. By the way, that's why they introduced something called the kiddie tax, which means that dad's going to pay tax on that income at his marginal rates. So it doesn't work. But the truth is, if they earn at what age? 16 years old? 18? If they're not earning it until 25. It's not age specific.
Yeah. Key word is earning.
Earned income. Well, no. Earned income is only for foreign earned income exclusion. Income is any kind of income. So, for example, if they're the beneficiary of rents in a house, if they receive any kind of income, interest, dividends, payments from mutual funds. I mean, if people have put the money aside for the child, most of the time, as I said, the parents are going to end up paying the tax at their marginal rates.
Okay,
so it wouldn't be a return. Okay. Upstairs?
Hi, sir. I want to ask you a question. I'm an American citizen. I was born and raised in New York. I've been living in Greece for 35 years. The last time I filed an income tax was a 1040 in 2004. You mentioned that earlier that, you know, if you live here, that you don't have to file. That I didn't know that this is the question. I haven't filed since 2014. It's a 10-year period. Is there a penalty for me that I work here and I collect rent?
We're going to cover the streamlined foreign offshore procedures in the second half, at which time you're going to learn that you only have to file 3 years of returns. Okay. We're down here now. Over here.
Let's say I didn't report income from a bank account, interest income, for 8 years back. How far back do I have to...
In the second half of the program, for now, under the normal procedures, you would report back 6 years.
And correct
under the normal
my
procedure.
return, right.
Under the new streamlined foreign offshore procedures, which we'll talk about in the second half, it'll be 3.
Thank you.
Over here.
I have been here for 38 years. I have never worked here in Greece, but I am now getting, and I have never filed an income tax because I don't have any income, personal income. My husband is not a Greek. He's not a U.S. citizen. He's a Greek citizen. We filed jointly.
In Greece?
In Greece. But I've never filed a U.S. tax form since I've been here. And now I am getting a Social Security. I have to file the Social Security now.
Well, only if you hit certain of the numbers here.
Okay.
I mean, again...
I get the minimum. I only worked 10 years in the States. So.
Well, what I'm saying is if you go back to the numbers, when you go to the website, look at the numbers.
Yes.
If your Social Security income, and that's the only income you have,
yes, I don't
is
have
less than $25,000 a year, you have no tax filing obligation because
so
you don't...
I don't have to file an income tax.
Right.
Okay. Thank you very much.
That's I mean, I'm not giving out legal advice here, guys.
No, I know.
Understand. Because I don't know, what I'm saying is if all the facts that you've just said are all the facts that are relevant, you don't have to file a U.S. tax return with that qualifier. We go over here upstairs.
Greek rental income. Heavily taxed here. Where is it reported in the 1040 form? And how is it taxed in the United States?
Well, there's a space on the 1040 for rental income, and then there's a supplemental form required to provide details of the rental income. In the United States, so you would presumably claim a foreign tax credit for the Greek tax paid on your rental income, and that you would claim on the foreign tax credit form. So on the summary, the 1040, which is a 2-page form, you would report the rental income. On a supplemental form, you would file all the details of the property address and, you know, all the rest of that stuff. And then you'd claim a tax credit for any Greek tax paid on that rental income.
Will you take depreciation on that, on the rentals?
The U.S. allows you to take depreciation. Well, you're jumping the line. You're jumping the line. There's people over there. But the answer is yes, you can take depreciation. I'm not going to let anybody else jump the line because that's going to mess up everything. Okay, we're back over here.
I wanted to know, do you do the 1040 whether you work for yourself or for a company? Is it the same form?
There is only one U.S. income tax form, the 1040.
Okay.
There's a 1040EZ, a 1040A. There's a series of 1040 forms. Mm-hmm. But it doesn't matter whether you're a billionaire or a pauper. If you have to file a U.S. tax return, you file a 1040.
Okay.
One of those kinds.
Okay. So it'll be a different 1040 if I had my own business? And because sometimes I've had my own business and then now I'm working for someone else.
If you have your own business, it depends on how the business is organized. And you would have, somebody who has their own business would have what's called Schedule C income. Mm-hmm. It's business income. So on the 1040, you would list whatever your net business income is on the appropriate line.
Oh, okay.
Then you'd file another form.
I see.
And then if you wanted to claim the foreign earned income exclusion or foreign tax credits, you'd go through that.
Okay.
One of the problems with the U.S. tax return and compliance is that the form itself is 2 pages. But we filed returns for U.S. citizens resident abroad that might be 70 pages because of all the schedules that have to be attached behind the return. The return is a summary, and based on what boxes you fill out on the summary, you have to then go to supplemental forms, schedules, information returns, etc., to complete the return. So when you sign the bottom of the form under penalties of perjury that you have filled a complete and full return, it's not just the 2 pages. It's all the appropriate schedules that should be attached as well. Over here.
Hi. Yeah, I'm an American by accident. My mother was there and I was born. I've never worked there. I have never earned any money there. I've spent a lot of money when I've been there. But I've never done anything sort of like with tax reasons for the U.S. I haven't filed. That's also something I haven't done. So how many years do I have to file?
Stay tuned for the second half. Okay? But I said to you earlier, and this is one of the things that troubles people. They say, I was born in the United States, I left at 3 months, I've lived my entire life in Athens, all my income is here, I have no income in the U.S., I have no assets in the U.S., everything's here. I pay taxes in Greece. Why on earth am I required to file and pay taxes, or file taxes at least in the U.S.? Because it's the law. I mean, I can't give you a more rational, more expansive philosophical explanation than that. Upstairs?
Yes. I'm over here. I
know you're up
yes.
there. I don't know where you are
okay.
up there, but... Oh, there you are. Okay.
If you moved here when you were like 20 and you were only a part-timer back in the States, but your parents were filing you under their own taxes, and you're married to a Greek, and you've been working here ever since, like for 30 years, when you file taxes, do you have to also show them your husband's income? And why should he get taxed if he's not an American citizen?
Well, I said to you earlier...
Yeah, that's what I don't understand.
Well, let me answer your question.
Okay.
That's why I said earlier that generally, as a default rule, if you are married as a U.S. citizen to a non-U.S. citizen spouse, you will not file a joint return. Because the United States permits you, I understand it's not permitted in Greece, but it is in the United States, to file married filing separately. If you file jointly, you are subjecting your spouse's assets and income on a worldwide basis to U.S. taxation. In some cases, that may not be a bad thing, because your spouse may have no income, for example, and you'll get the benefit of a larger exclusion, etc. But in most cases, you want to preserve the ability to engage in tax arbitrage. And you certainly don't want to subject your spouse's income to U.S. tax. It is absolutely legal. That you can take home with you. It's absolutely legal.
I need to come back to these totalization agreements, I think, for my son. Mm-hmm. He was born in the States, but of course we live here. And now he's going to work for an American company. So he will pay, of course. He will file for the United States.
He's working for an American company where?
In the States. Well, I mean, it's a cruise line. So it's a cruise line based in the States. But of course, he works and he travels with ships all around the world.
Well,
now, the thing is, he pays he's going to have to pay for the U.S. and he pays here as well for his tax, for his future pension. So how does that work?
Well, I really can't answer that question because most of those ships aren't owned by U.S. companies. They're owned by third-party companies like Marshall Islands, Liberia, etc. And he's probably employed by a crewing agency, perhaps based in Cyprus. So
my husband will know that. He's right.
I have no idea. If he is working in the United States.
No, it's not in. It's
in
and out.
I heard what you said.
Yeah.
You say that it's a U.S. company. It's probably one of the big U.S. celebrity cruises or somebody.
Exactly. Yes, it's what it is.
But the fact is, his employer is probably not the U.S. publicly listed company. It is probably a subsidiary or a crewing agency or a crewing. So I can't answer your question. I just don't know. I honestly don't know.
So who can help me answering that question? I mean, it's kind of he pays twice. He's going to have to pay there and here anyway.
Well, he probably doesn't want to ask the Greek authorities because they're going to say pay here.
Yeah, for sure. He's already doing that. He's already paying his deductions.
I don't know. I think the thing you got to do is find out who his employer is. You've got to find out who his employer is, because he's not being employed in Greece. He's not being employed in the United States.
Yes, he is. I mean, he's employed in the United States.
Does he report to work in the United States?
What do you mean?
Does he go to work? Does he show up at a place in the United States?
Well, he takes the ship wherever he has to. It could be here, it could be in the States.
Right. Well, you're asking a very specific question that I can't help you with. I'm sorry.
Okay, thank you.
Over here.
Hello. Is there any difference if you're self-employed with self-employment tax about the Social Security? Do you have to pay something in advance? That's what a friend told me, but I'm not sure if it... And that's the first question.
Self-employment tax by somebody who is self-employed in Greece and works in Greece is exempt because you pay that to whatever ICA or variation of ICA that you pay for here. So you have to file a form. But you should not pay self-employment taxes if you work and live here in Greece.
Right. And do we have to attach any, paper stuff with it and translate it into English to send it to the IRS? Or do we just fill in the forms?
You just fill in the forms.
Right. Thanks.
I mean, one of the beauties of the U.S. tax system for all of its complexity in terms of compliance is that you don't have to attach all kinds of documents, all kinds of support. If you say your general income from your work, your self-employment, was 25,000 euros and your expenses were 8,000 euros, you don't have to provide any support for those numbers. Now, if you get audited, you better be able to back them up, but you don't have to provide them with your return.
Sorry. But then if something happens, do we have to translate the whole... If we're checked or...
Well, if you're wise and you use somebody who knows what they're doing, you will never have to translate them. You'll simply provide them in English.
Thank you.
Listen, we had last year have to get U.S. tax returns translated and notarized to go send to the Greek tax authorities. I mean, it's crazy. It doesn't happen in the States that way. You don't have to do that. Upstairs?
Yeah, I'm an American citizen who had a salary job in 2014, but for the second part of 2014, I had a scholarship which brought me to Greece. So how would I file the money I got from the federal scholarship?
Scholarships are not income.
Okay.
So you'd have your employment income.
Okay, so I wouldn't file
You would not,
any of that. Okay.
No, you wouldn't report. You wouldn't report your scholarship income as income.
Okay.
So if you got, for example, you made $15,000 while you were working in the States, and then you got a $15,000 scholarship, your income is $15,000.
Okay, thank you.
We're over here again.
Okay, I'm a Greek citizen, and my income derives from ship owning and chartering. It is well known that the Greek shipping cluster is the most reverential tax-exempt status ever. So I'm going to pass now to my 3 children who are U.S. citizens the beneficial ownership, parts of it. So...
You said you're not a U.S. citizen?
Me, no, but my children are.
I suggest you get some advice. No, I'm serious. I represent a number of U.S. citizenship owners, and there are mechanisms that can be employed to deal with that tax situation, because there is a huge differential between the Greek taxation of shipping dividends and the U.S. taxation of the same dividends. So unless you take some kind of prophylactic action, then there'll be no Greek tax credits to offset the dividend income received in Greece, which would otherwise have no tax.
Yes. My daughter is an American citizen and receives no any other income but a scholarship from the Greek government. Is that considered an income to be reported?
No.
Okay. Number 2.
Now, it's important that you listen to the questions and the answers before you ask the questions, because that way we can probably get more questions in and more answers.
No.
Sorry.
We have the right to file our returns by the 15th of June without any penalty for late filing, right?
Correct.
Okay. Now, in case, though, that we owe money, in other words, in case our computations show that we have to pay a tax, say $100, then we have to pay interest and penalty.
No.
How come?
Actually, we're about to challenge the Internal Revenue Service in the tax court on the application of interest to tax payments made by U.S. citizens living overseas if they are paid by June the 15th. Your obligation by June the 15th is to pay the tax due. You don't have to file the return that day. You can actually file an extension for 4 months. So if you've calculated that you owe $100 in tax, you would file a Form 4868 with a Schedule V with your tax payment. You'd have to draw it on a U.S. bank or have a U.S. dollar money order. You'd ship your $100 to the IRS by registered mail, and you'd be fine. The IRS will, today, assess you an interest charge on the 60 days between the 15th of April and the 15th of June.
Correct.
We have challenged that. We are about to challenge that.
Yeah, I pay that every year.
Well, good. You should join our challenge.
And not only that, but the nature of my question is this. This year, they asked me also to pay a penalty. And I don't know why.
I don't know why either.
They did not provide to me any explanation for that. And the root of my question is this. Where can I was never able to find in any publications, or I am stupid, a way to compute that interest.
Well, actually, the interest is computed according to the notice you got, and it's a quite complicated interest formula.
That's exactly.
It's a monthly one based on federal, interest rates, Treasury note rates. But, that's a pretty special question. Why don't we move on to another question? Because I can't really answer
and
that.
The last question. I'm getting Social Security benefits. And my wife, who works, she will retire pretty soon, and she will also, they told me at the embassy, will get half of what I'm getting. Now, she's not a U.S. citizen. I am. And she will, does she have to pay taxes for that amount of Social Security?
If you don't file jointly with her, no.
No, we file separately.
If you file separately, she's not a U.S. citizen, they'll simply take 30% as a withholding tax and pay her the balance.
So she will be getting that amount of Social Security benefits without any taxation from the United States?
With a 30% withholding.
Whatever.
Social Security payments made from the United States to non-citizens resident outside the United States are subject to a 30% withholding tax.
Okay. Thank you very much.
Okay. We're upstairs, I think.
Hello?
Have I lost the rhythm here? We're going this way, and that way. Right. Okay. Got it.
Hello?
Yes, ma'am.
Yeah. I received a letter from my bank about this FACTA thing that I...
FATCA's the second half.
Oh.
Okay, over here.
Yeah. A few years ago, I called the IRS when I was in the U.S. And I explained my situation, that I was a U.S. citizen living in Greece, and what do I do with my taxes? Their answer was very specific. Nothing. You don't have to file. I asked them to give me something in written form. They said no. Just take my word for it. That was over 20 years ago. So I can understand everybody being in a mess here. All right, so that's...
You didn't get the name and number, I take it, of that person. Would have been helpful.
It would be.
Yes, sir.
Two very simple questions, actually three. One is I saw that you specified what a U.S. citizen is. I couldn't find if a U.S. citizen has an adopted child.
There's a new act that was passed a couple of years ago that makes it quite easy for adopted children of U.S. citizens to get U.S. citizenship. Obviously, I don't know that law, but it's certainly possible, and I think they made it much easier.
All right. Several years ago, my mom, before I got married, my mom and I had and still have an account in the U.S. We put it up just for her to get pension, and that's what was done for the last quite a few years. Now, the last few years, I added money in there, and I am doing options and stocks and stuff like that. Right now, other than her pension, you also see revenue, let's call it that way, from options. Does that add up to my... the account is in my mom's name and my name as well.
But it's a U.S. account?
It's a U.S. account.
But the income from it has to be reported on whoever's return gets the income.
So it's just a simple tax return there.
Yeah.
Mm-hmm. All right, fine. And my third question is, because this is difficult stuff, are you going to recommend someone here or somewhere where we can file our taxes?
Well, we can deal with that in the second half, okay?
That's
Toward the
what
end.
I want to hear.
Okay,
Okay, great, thank you.
Over here.
In regards to the interest income, as you know, the Greek government automatically taxes that directly from the banks at the rate of 15% currently. Now, since this income is already taxed and we have no choice about it, do you report this as well to the states?
Yes. Remember, you're subject to tax on your worldwide income from all sources and for all types of income. In the United States, you have to report your gross interest income, and you claim the 15% tax as a tax credit. All right? Now, that's one of the areas where the two systems diverge. In Greece, you pay a flat tax on interest of 15%. It used to be 10, now it's 15. In the U.S., you pay tax on interest as ordinary income at your marginal rates. So it depends on how much your total income is as to what your eventual marginal rate will be. So as long as your marginal rate is 15% or less, your Greek tax credits on interest will cancel your U.S. taxes. The problem will occur is if you're in the 28% tax bracket, you'll have attracted 28% tax on your interest, but you'll only have 15% of credits to put against it. So you'll pay the U.S. the differential. Now, that assumes you don't have other passive foreign tax credits that you can use to offset the gap.
Thank you.
Okay, upstairs? Now, you guys must be getting tired at some point. You got to be tired. So we got to go get some coffee pretty soon. One more question up here.
Yes, I have a question regarding purchasing a home here in Greece or selling one, if we have to report that somewhere. And that's question number one. And number two... Let
me answer question number one.
Okay.
Purchase of a house is not reportable on a U.S. tax return. The sale of a house is reportable as a capital gain if there is, in fact, a gain. If you buy a house for 100,000 euros and you sell it for 120,000 euros, you have a $20,000 capital gain. If you bought a house for 100,000 euros and you sell it for 90,000 euros, you have a $10,000 capital loss. So when you sell any asset, that includes stocks, bonds, you name it, houses, you take what's called basis, that is the price you paid plus any expenses related to the purchase. You then look at the sale, and you look at any costs of the sale, so you take the net sale value. In this case, because you live outside the United States, you have to take the specific foreign exchange rate in effect on the day of the purchase and the specific foreign exchange rate on the date of the sale, so that you convert both the sale and the purchase into U.S. dollars. And if you have a gain, you declare a gain. If you have a loss, you claim a loss. Does that answer question number one?
Yes.
Okay, now question number two.
And my second question is, my husband works here in Greece, but he also works for 5 months in U.S., and we file taxes in both places, and he also contributes Social Security in both places. Will he get Social Security from both places at the end?
Yes.
Okay, thank you.
One last question down here, and then we're going to...
Okay.
Then we're going to break. I need a break.
What about if the house was inherited, or if you have built the house, going back to the previous question yourself?
Okay. All right. An inherited house will be valued at the fair market value at the date you received it. So and this may be difficult because, of course, if you received the house in 1985, you're dealing with drachmas, you're dealing with objective values. You got to use your best effort to kind of find out what the sort of fair market value was as of that date. So it's the fair market value of the date you received the inheritance. If you purchased the house, that is, you built it, you bought the land, you paid for the construction, and I know there's a system here in Greece where you can, I can't remember what it's called, but where you give the land and they build 5 apartments and you get one. What I'm saying is if you bought the land and you paid to build the house, the cost of the land is not included, all right, but the cost of the construction is. And you keep adding that up, and so you paid $200,000 to build the house. You paid so much for the land. You add the two together, and that becomes your basis. You sell it years later, and you do the same exercise. You go through what did I get for it, minus what I paid for it. The difference is your capital gain. You're welcome. Fellas, can we take it? Fellas, that's very bad of me. Don't throw any eggs at me yet. We're going to come back, and I'll be happy to answer some questions afterwards. But why don't we take a break? I need a break.